We're going to be talking about the future of initial public offerings. And with me, I've got Joe Mecane, who is a mastermind of direct listings and alternative to IPOs. I've got Leslie Pfrang, who's a partner at Class 5 Group, which is a top IPO advisory firm. And we've got John Tuttle, who's the vice chairman and chief commercial officer, recently got a promotion at the New York Stock Exchange. So tomorrow is a big day. John, you're going to be hosting a party at NYSE for a little company called Slack. What should we expect to see tomorrow? They haven't gone the IPO route. They've gone the direct listing route. What are we going to see tomorrow?
Yeah, well, tomorrow we're going to see the second direct listing of this caliber come to market on the New York Stock Exchange. So you'll see a big group of executives from Slack come. We'll see the market open at 9:30 tomorrow morning, and we'll see a very robust price discovery process take place on the trading floor. Joe's firm is the one that will be opening the stock and supporting the stock.
Actually, just moments ago, the reference point of the price of this stock was decided upon.
Right. So we established a reference price of $26 per share for Slack, and this is different than an IPO, because on an IPO you have an IPO price where shares are placed or sold or transacted at a certain price. In this case, no shares are trading hands. This is simply a piece of reference data that will be used by traders, by investors, and even as an input into brokerage systems for them to be able to accept orders going forward. So tomorrow morning, just to finish, tomorrow morning we'll open the market. We'll see a very robust price discovery process take place. There's no stabilization agent, green shoe, anything you would see in a traditional IPO. We expect it to take a while to open. With Spotify, the market opened at 9:30. The stock opened somewhere around 12:40 p.m., 12:43 p.m. So we want to, we as the New York Stock Exchange and Joe with his firm want to take as much time as necessary to have the price discovery process play out.
And this $26 per share thing, this is basically a suggestion, because there are no banks underwriting this. They're not guaranteeing any money. It could go anywhere, the price.
Right. So the exchange, one of our responsibilities in a direct listing is to take a look at private market trading data. And if there isn't some, or if there's other data points we should consider, we'll take those into consideration, and we'll consult with the company's financial advisor. And financial advisor is this new role. It's, I would say, cousins to the underwriter in the listing process, and we'll establish a reference price the evening before, and that's what has happened.
Joe, how do you go about getting a reference price like this?
Sure. So as John said, when the direct listing rules were established, there were rules implemented to come up with this sort of starting point. But it's a data point. It's kind of in the backdrop. Ultimately, where the stock opens tomorrow morning is really going to be based on supply and demand. And so our role as the market maker on NYSE is to find that correct price. Our responsibility is getting it open at the right price, and then trying to dampen as much volatility as we can, have it trade as smoothly as it can in its debut. As John said, there's no formal underwriting process, there's no stabilization agent, and so there becomes a heightened need for us as the market maker to use our capital and our liquidity to help it trade in as orderly a manner as possible.
You talked about the possibility of heightened volatility in the markets. But we saw with Spotify, it actually went pretty smoothly. Is this like a tale that the underwriting banks are telling to make people not go the direct listing route?
I think it's a risk that's there for two primary reasons. One is, as John alluded to, there's no IPO transaction beforehand, right? So in a normal IPO, the night before, there's almost like a mini auction that happens with the company shares and whoever is participating in that auction. And so you come in with a little bit of a backdrop of what that process resulted in. Again, it's not necessarily indicative of what the public market is going to price the shares at, but it's at least a little bit of a backdrop. And then secondly, the big difference with the direct listing is the company's not selling shares. So the only shares that are coming to market are shares that are coming from existing shareholders who are selling. And so you have a little less clarity than you do in a traditional IPO about what that's going to look like. I think what that does from our standpoint is it puts a little more pressure on the market maker itself to use our capital to make sure that it trades smoothly, and that's what we'll be doing tomorrow, but it's a little bit of a different process.
So you said that it went smoothly and it looked great. From their perspective it did, and let me just get on record and say We support direct listings. We're happy if companies want to list directly, and we're here to help them because the preparation for a direct listing is no different. Companies still need to do the same amount of work. They need to get public company ready and operate as a public company post-IPO. So the process is very similar, and in fact, in Slack's case, it looks a lot more like a traditional IPO because they actually hired what looks like a syndicate, but they're called advisors, and the fees are similar to what they would pay for a transaction that would sort of match their market cap or what the reference price. But the long and short of it is that Spotify priced at the high of the day, right? So the first trade was the high for the stock for quite some time, I believe, and it's now just recently gotten about 10% above that price. And that's great for the company because they didn't have the IPO discount on 7 to 10% of their shares. But for public investors and institutional investors, that's not necessarily a great result if they bought a big slug of it in that first trade because the markets are up 20, 30% since then. So I think it'll be really good for direct listings if Slack goes well. And I also think that people need to understand that there's a narrow group of companies that can actually do direct listings. You need a certain type of characteristic.
I think what Robert was alluding to along those lines is 2 points. One is it did open at the high of the day, which was one of the things that I think was expected with a direct listing, and one of the things that's also gotten highlighted as a potential outcome for Slack tomorrow. Obviously, very hard to know.
Why is that expected with a direct listing? I mean, I don't understand why you would expect it to cross all of that stock at a high. That to me doesn't.
Yeah, and I don't think it's necessarily characterized as good or bad. I think it's more of a mechanical point. So, again, going back to what I said earlier, the only shares that are coming to market are from sellers. And so in a normal IPO, you're always worried about buyers and sellers showing up. You're usually maybe a little more worried about whether buyers are going to show up. In a direct listing, you're dependent on, again, the existing shareholders to sell. What a normal process would look like in a lot of cases is if you're a shareholder, you'll sometimes just sit and wait because you want to see what's going to happen. In which case, again, mechanically, you could end up in the situation where you've got buyers showing up. You're not as clear whether the supply is going to show up to the market. And so if that's the result, which again was what people thought might happen in the Slack, in the Spotify case, and we'll see if it happens again tomorrow, is you start with more demand than supply. It equalizes over the course of the day, but you end up with that form.
John, it looked like you want to say something.
Yeah.
Sure, I was just going to say, building on Leslie's point, a direct listing isn't for every company. We have to remember, why do companies go public? First and foremost, it's to raise capital, either to grow and expand their business, make investments, return that capital to investors, shareholders. It's to have liquidity, it's to gain visibility, it's to have a share currency that they can use for M&A or to incent employees. Now, for a direct listing, in many cases, a company that would qualify is a company that does not necessarily need to raise capital at the time of their listing, but they want those other benefits of being a publicly traded company.
Why would a company choose to forego a potential funding round? Why leave that on the table?
Some companies are incredibly profitable at IPO and have trouble, having a use of proceeds. So there are some companies it makes sense for, but I think you need to have a well-known brand, or I think not every company is if you don't have some name recognition, if institutional and public investors don't know who you are, it's hard to educate them without
How many Slack users do we have in the audience?
Right.
All right,
so
good awareness.
That's a
The entirety.
And
The other.
I was going to say to
Joe.
Joe and Leslie's point, one of the requirements to be listed on the New York Stock Exchange is you have to have 400 round lot shareholders on the day of your listing. That ensures there will be ample liquidity on the day of your listing. And if you're a private, and that's a big role of the underwriters, is identifying the investors and placing those shares to make sure that there's sufficient liquidity on the first day of trading. Now, a company that would meet the qualifications for a direct listing needs to have that distribution on the day of their listing. And if there is no underwriter placing shares, there is only a finite number of companies at this point that would meet that, where they have ample, a wide breadth of private company shareholders that would eventually turn into public company shareholders and provide liquidity on day one.
The other two things on why a company might choose this path is you generally don't have lockup agreements, which you would normally have in an IPO. You know, whether that again, that might not be something everyone is looking for, but it's a different path than most IPOs.
Do we know whether Slack has a lockup?
As far as I know, they don't, but I don't want to speak for them. And then the other is you're not diluting your existing shareholders, whereas in a normal IPO, you raise capital, everyone dilutes their ownership. In this case, you don't have that dynamic.
And I would say, just touching on that as well, one thing that's interesting about the direct listing is that market conditions matter a little bit less than they would in a traditional IPO. And when you're going through the IPO process, you want to de-risk as much as possible. And so having macroeconomic events or geopolitical events take place when a company's on the road, placing their shares, getting ready to list, can impact the IPO and the pricing of the company's stock. When there are no shares actually being sold, that kind of broader market volatility or macroeconomic activity matters a little bit less. So companies can come to market on their own timing.
For instance, if there were tariffs that were going to be levied, or maybe the Fed cutting interest rates or something like that, maybe you wouldn't want to do it. But let's switch gears a little bit and talk about these mega IPOs that we've had this year. What's been going on? What separates the winners and losers here? We've had some lackluster IPOs. Lyft and Uber, I think, were pretty underwhelming. People expected them to be the biggest IPOs of the year, and investors were not as receptive to it. Meanwhile, you have other companies like Beyond Meat and CrowdStrike that are just popping off, doubling their valuations instantly. Leslie, maybe you can weigh in here.
I mean, you say what separates the winners and the losers. I think one of the things that's going on is companies are staying private for a very long time. The Jobs Act took up the number of private investors they're allowed to have to 2,000. And there's also dynamics in the market where private capital has advantages over public. We talked a little bit about debts deductible, carry is, capital gains. So private money is, super aggressive, very light governance terms. And companies, are sort of getting, ahead of themselves without a lot of, grown-up controls. And I think the companies that are successful are the ones that are preparing for IPO, transitioning their boards to have independent directors. We hear a lot of people complain about Sarbanes-Oxley and the cost of going public, but those things, doing a higher level audit, putting the right controls in place, having internal audit, going through the discipline of, putting a unit economic model and a path to profitability in place, telling your story, looking at having lawyers crawl all over, look at your IP, your risks, things like that. It does make a company a lot stronger to execute, and public investors see that. And so, to me, the winners are those that have put that discipline in place. They can articulate their growth story well. They've underwritten the growth drivers with investment into IPO. They're articulating a clear path to profitability. Those are the companies that are doing really well.
You mentioned getting discipline with an independent advisory board, and yet so many of these companies are adopting dual-class share structures that give them super voting rights, and basically, they don't really have to own up to anybody.
Dual-class. I mean, if you're a founder, and again, I don't mean to cut you guys off.
No.
Most of our companies are VC-backed and founder-led. I mean, one of the things that we really pride ourselves is trying to keep founders in control. If they want to lead the company into the next stage, we want to help them learn how to do that and be really, really good at it. And they're in a bit of a vulnerable position when they go public because there's very little liquidity in their stock. Something can happen where the price of their stock comes down, and they have a very concentrated investor base still in VCs. And so it does protect them, for that period of time. And the other thing is, the public markets are very quarterly oriented, and having a dual class stock that has reasonable terms, clear sunset provisions, that type of thing, does help them stay focused on the long term. So we're, I know there's a lot of controversy around it, but we're not.
Yeah, there are definitely competing views from some of the asset managers versus some of the IPO firms. Our view from the New York Stock Exchange is that, look, this isn't a competitive issue amongst exchanges, amongst geographies, about whether you're allowed to have weighted voting rights in one jurisdiction and not in another, it really turns into a public versus private debate. And so, if dual class structures are disclosed, in some cases if there's sunset provisions, investors can make informed choices, because the more restrictions we put on public companies that don't exist in the private markets, the more attractive we're going to make the private markets to them.
That's right.
To Leslie's point, you do not have, well, in some cases, not in all cases, but in most cases, you do not have the discipline that the public markets require from a financial standpoint and from a governance standpoint.
How many people have invested in one of the IPOs this year, whether publicly or privately? Raise your hand. Wow, just one. Oh, a couple. All right. So also, let's talk a little bit about the age of unicorns. And as you mentioned earlier, all of this private money is available for investment. It seems like the game is stacked against retail investors. Is that the case?
Well, I mean, that's a very loaded question. I would not say so. I would say that we encourage companies to come public earlier in their life cycle, at the right time for them, but a little bit earlier. Instead of coming out in maybe the 8th or 9th inning of the game, come out in the 3rd, 4th, or 5th inning as well, which we believe that companies going public is a good thing for society in general. People talk about the bifurcation of wealth in this country and around the world, and when companies wait until they're much later in their growth cycle and retail investors don't have the opportunity to participate in that company's growth, that's not good for retail investors, that's not good for the market, that's not good for society overall.
There's stages in companies' development where there are a lot of very smart venture capitalists that are incredibly helpful and experienced at building companies when they're still in that high risk phase, when that is where they shine, right? They're really good at that. I think there's some structural things that probably encourage companies to stay private longer than they should, and probably in some cases longer than their VC investors even want them to. So I don't know necessarily if it's that black and white, right? But I think it would be in the best interest of everybody if companies would appreciate the discipline, the benefits of moving towards being a public company rather than view it as a pain in the ass.
Right.
I got to beep on that, but oops. But
you beep that out.
Yeah.
But you understand what I'm saying. They shy away from it because they think it looks hard. But what doesn't kill you makes you stronger.
I'm going to open the floor in just a minute, but Joe, I wanted to give you an opportunity to weigh in here as well.
Sure. I mean, I agree with everything that was said. I'd say from a macro standpoint, two things. One is valuation is also difficult, I think, with a lot of these companies, just as the backdrop. And until you have the discipline of the public market actually opening, you don't really know what the company is going to be valued at, is one point. And so
that's been made very clear this year.
And I think that's part of what we've seen. And you've seen some companies with very, very healthy valuations, but the macro environment that companies come to public in is a big impact on, I think, a lot of that. The other point I would make is that on retail specifically, not to go back to direct listings, but just one of the other points that has gotten raised about direct listings is, for better or worse, that opening price is the price that everyone who's buying or selling in the public market gets. And so I think when Spotify went public, they were talking about it as the democratization of finance, and one of their justifications was that retail, who usually doesn't get to either participate in the initial IPO or doesn't get to participate in some of the early rounds, at least gets to participate in that initial debut on the public market. So
I like that line, the democratization of finance.
It's not mine. Barry McCarthy gets credit.
But you also have to think about what does it do to, so maybe employees did get to sell some on the first trade, but what does it do to them if the stock is, what do they think if the stock then trades down 15, 20% for a prolonged period? How does that affect your partners, your employees,
Yeah, I mean, it's the same as if you're selling at a 15% discount. I mean, it depends on what side of the trade you're on.
That's right.
And, I think there's different mechanisms that suit the strategies of the companies differently. It's, whether you're a buyer or a seller sometimes.
I just think there's a lot of considerations when you're thinking about the path forward.
All right, let's see if we can squeeze in some questions. Does anybody in the audience have a question? We've got Sean Tully back here. My colleague from Fortune.
In in general, when you have conventional IPOs, a lot of times the success of the IPO, at least in the media and maybe even in the investment community, is based on how much did it pop that day. Okay, that's never made sense to me, because when it pops, it means that the company's left a lot of money on the table, has underpriced its shares, and effectively would have a much higher valuation if all that cash were in the treasury instead of going out to the folks who bought the shares during the underwriting. So my question is, for all three of you, is the right measure of the success of an IPO how much it pops on the first day?
All right, so why do we celebrate the pop? Who wants to take it?
It makes a good headline. That's why. I think if you look at tech IPOs last year, the average quote unquote pop was something around 38 to 40%. And that is, you could argue that's cost of capital to a company as well. So I don't think we should be celebrating it. I think we want to see a nice, robust price discovery process. We want to see a well-priced IPO. We want to see a nice, robust price discovery process. We want to see a chart that starts in the bottom left and ends in the upper right, not only in IPO day, but over time as well.
Yeah.
Joe, Leslie?
Yeah.
I mean, we don't celebrate the pop. Believe it or not, there are some management teams that want a pop, and there's others that don't. And the banks show you data that if you don't pop a certain amount, you're more likely to break issue. And some management teams just don't ever want to break issue because they think it's a psychological thing with their employees, and so they decide to price the very small amount of the company that they're selling, which on average is kind of 8 to 12%, at a 20 to 30% discount, right? And so, all the companies we work with have a different view on what they want. Some want to optimize for the last dollar. Others want that headline of, gee, the stock's up. But you have to remember, it's a small part of the company that you're selling an IPO. And the other side of that coin is, if you're putting those shares in the hands of big institutional investors rather than allowing your underwriters to allocate it to 5,000 investors, if you're concentrating those shares, that pop accrues hopefully to your long-term shareholders, and they have a lower average cost, which allows them to buy more to get to their price target, right? And so there are some structural reasons to do that as well, to sort of retain your shareholders, because they're never going to get enough in the IPO. And so,
Yeah, I mean, from our standpoint, I agree with you. I don't think the pop is the measure of success. I think everyone wears different hats and has different perspectives. Our role at Citadel as the market maker is not necessarily trying to impact any valuation levels, but just trying to make sure it trades in a smooth, orderly fashion. People can get in and out of the stock in an efficient manner. From our standpoint, that's what we would declare as success. I think it just depends on what hat you're wearing.
As much as I would love to accept another question, we are running out of time, so I'm going to take the last question. Sorry, everybody. But so we're all agreed, no champagne popping over the pop. But we've been talking a lot about blockchains and cryptocurrencies at this event. There was this initial coin offering boom that happened not so long ago. People were raising crazy sums of money. How do we expect these two technologies to influence what you're doing at the New York Stock Exchange, John? And we can keep it quick.
75 years ago, people were carrying around share certificates in a bag every day. Then they became digitized. Will the markets evolve? Absolutely. Are some of these technologies at the maturity in which that they can actually improve the market? Not yet. But the markets will continue to evolve, and technology will be leading that evolution, driving that evolution.
And your sister company, Backed, is working on some of these challenges right now.
And you'll hear from them tomorrow.
Excellent. All right, well, thank you all for joining me. That's our panel on IPOs.
Thank you very much.
Great.